Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in and take a look, see what's going on today. If you want to follow me, it's @Finance. And if you want to join our community, finding-value.com is where you want to check it out. I dive deeper into a whole bunch of different things and share that share everything with the community. Uh, you can see the special code in the corner there. Here we go. So Gold Silver HQ says the world is dumping US bonds, but magically someone is buying it all. Spoiler, it's the Fed, keeping rates low and the illusion alive. I do think they're in there buying bonds. I do think that they're in there trying to hold rates down. I think they're trying to even hold oil down. But you know what? They can only do that for so long. I think the market's going to overpower them, whatever they try doing. If they continue to try to do what they're doing, it will show up in a much weaker dollar, which will push some of these dollar-sensitive assets. If they're priced in dollars, it's going to push it higher. I think the dollar is going to eat it, and that is what I'm seeing across the board in a lot of these different charts in commodities like copper, platinum, palladium, gold, oil. It doesn't really matter what it is. Anything priced where you've got dollars in the denominator on the bottom end of it, I think we'll see very big moves to the upside. We've got the path to 7,000 for the S&P 500. You can see that the S&P is also breaking through some resistance to the upside, showing all-time highs. So that weakness in the dollar. So what they're doing, in my opinion, is that they're holding interest rates down, and they're going to hold the interest rates down low enough where it does not impact the S&P or the NASDAQ from materially going lower. So if they are successful at pushing yields down, we could still see people seeking returns, moving money still into financial assets to some degree. It doesn't mean that commodities won't go flying higher. There's even the chance that commodities would vastly outperform the S&P 500, and the S&P 500 doesn't really go down. It may still go up, and that's due to the weakness of the underlying currency that it's priced in. That is what I think is going on, and they need tax revenue. They being the government, they being the Federal Reserve, they're kind of working together to create a condition where all assets may go up together. But it doesn't mean that other ones like commodities or precious metals, you might see them outperform these other financial assets. Now, if these don't fall a lot and we see a major repricing in these ratios, it means that the S&P, the denominator, when you do like a gold to S&P 500 ratio, that it's not falling, which means that gold has to go astronomically higher, or platinum, or whatever else it is. That is a possibility where we get an astronomical repricing of commodities where financial assets don't go down very much, but commodity prices go up insane amounts. JSG says it's a shame that inventory doesn't matter, but if it did, the implied fair value price for WTI based on either total commercial petroleum stocks, excluding other oils, right, it's the right figure, or the commercial crude oil stocks, the left figure, is in the low 90s. Long crude oil by way of open CLU 25 position. So what this is he put a dot plot and then you fit lines to it. It's basically a regression analysis. You've got your standard deviations from the average. So the dark red is your average. Then you get one standard deviation, two, and then the majority of the data should fit within two standard deviations around the mean. Right now, the blue is where we're located. The fair value, you need to go up to the average, which is in the low 90s. Overvalued at this particular range we've seen it as high as $130 a barrel given our commercial inventory levels. So we're actually on the low end here. You can see a couple of other data points right around here in history that have been even more mispriced in relationship to commercial inventories, where they were priced in the 60s, but should have been priced in the $110 range. This is where I live. I love seeing these types of mismatches in the market because I think the market is mispricing it. If we get some bills passed, if we get some more stimulus coming through the system, I think oil is completely mispriced to the downside, which is good. That's what you want to have if you're taking positions in the markets, and you want to see undervaluation. It's also very cheap in relationship to gold and other assets. We also have bottoming patterns showing up in the underlying equities that we want to invest in. That's the type of, I call it confluence, that I would look for entry points for investments. Silver's on the launch pad, ready to take off. I couldn't agree more than this. We're up above that resistance area of about $35. It's been tracking sideways. A lot of the times what occurs is it takes energy to get through resistance. After that energy's been depleted, it basically regains that energy by consolidating sideways on top of support. I do think that at some point here, at any second, we could see a big move in silver. Now, I don't play the short-term market movements. What I do is as I take a big picture view. This has a huge cup and handle pattern. I've been playing this since 2018, and I had some silver before that, but I really upped my stake in 2018. 2020 was a pretty good year for accumulation for me as well, and I think this is going to go way up over time. So we're continuing to see the short term look good too, but I think the long term is where all the money is going to be made. I don't think catching these small minor movements is really a big deal. I think I want to play it to multi-$100 silver out in the future. And there's many reasons of why that's going to occur. And I'm not going to name all of the reasons, but one of the main reasons I think will be weakness in the dollar. And silver is priced in dollars. Rock bottom entry says the US dollar is decisively breaking its 14-year uptrend. This is what I'm talking about in weaker dollar and the repricing and the movement from money where it used to prefer financial assets. And I think going forward, it's going to prefer hard assets. But if they print enough money and they lose enough value in the currency, we might still see financial assets not drop very much. So commodities are breaking out across the board. Make hay while the sun shines, as they say. The next few years will be the best money we'll make in our careers. Hang up the gloves once the super cycle ends. That's exactly what I'm doing. I'm going to make probably the best money these next few years of anything. Last bull market in commodities, I saw ridiculous moves. I mean, ridiculous, guys. We're talking 10 to 100 times money was made from bottom to top. Last bull market from about 2000, I'll just say 98 to 2001 was the bottom for a lot of the commodity stocks. And then towards 08, we saw some ridiculous moves between that time frame. I think that we're in the same exact time frame as 2000, 2001. And then I think we'll get a big up leg move. And this will be probably the best return for anyone in the markets. These commodities move much quicker than tech stocks and a lot of these other regular companies. They can do decades of returns in single-digit years. So that is what I'm geared up for. That's where my mindset's at, is playing the entire market of this bull market in commodities and being able to hold on and realize those returns. So I'm setting up a portfolio, and again, You guys can see that on the website there. There's the dollar that he's got here. It says the DXY is breaking critical support, commodity super cycle check, the likes of which we haven't seen since the early 2000s. Totally agree. And here we are trying to break that uptrend line. And again, I show that on the daily updates. We're right there trying to break lower. Sam Gitling says, or Gatling, while many energy stocks have suffered corrective waves recently, the oil refiners ETF has continued to print fresh highs. Do you think it has anything to do with the short sellers carrying their largest position in years? So we've got short interest at new multi-year highs, and then oil refiners ETF crack continuing to go up. That looks good to go higher. You can draw a trend line through here, broken downtrend, failed breakdown into a slingshot move higher. So this looks really good to go up, not down. And I know some people say, "Oh, the short interest is way up." What do they know that I don't know? I wouldn't go that deep, guys. Follow the chart. We're probably going to see a big move up. 85 Brent Proponent says there's no more distillate EIA. There's no more crude EIA to grab from to help make more distillate. When you refine too much crude, you end up with a glut of gasoline, hurting crack spreads for U.S. refineries. Something's got to give. Bullish Western Canadian Select heavy crudes. I agree. Check this out. Look at the inventory levels of this. So this is total petroleum. We're underneath. We've been going up a little bit, but we're underneath our averages. Crude is really low. Crude itself. Distillate is off the chart low. And gasoline is kind of in the middle. So gasoline's kind of average, but distillate is off the chart. We need heavy crude. We got to get moving and making more distillate. Diesel is basically what I'm saying there. Don't panic. It says U.S. crude inventories very low. It says you are here. We are 10% below the you are here versus the 5-year average, and then this is versus the 10-year average. So we are drawing down like we have been versus those averages. JD Vance has said, I'd love to hear an argument for why Powell cut rates 50 points right before an election, but can't do it now with inflation lower. Yeah, I can't. I don't know why he cut rates 50 points. I don't know why he did that. But I do think that we need rates that are high, not low. A lot of people are saying, oh, inflation's over. That's not what I'm seeing in the charts. It's not what I'm seeing in the dollar or DXY. I think inflation is going to come raging back. And the only thing between us and that inflation is increased interest rates to slow it all down. If we start to lower interest rates, then I think that's going to open a path of inflation like a monster. And I don't know. I mean, we'll see what he does. In 2025, you have the ability to buy 4 times more oil, 9 times more steel, and 35 times more grain for 1 ounce of gold than in 1950. Yeah, but gold's expensive, in my opinion, in relationship to those assets. I think that oil, steel, and grain, maybe not grain so much, but oil and steel are a better buy right now than gold. Gold leads, it becomes expensive, and then everything else catches back up. So we're in the catch-up move, I think, soon, where oil and steel and all these other iron ore are going to go up tremendously. That will be very inflationary. The only thing between us and that is interest rates. Interest rates has slowed down the economy. That's exactly what Powell is doing. He's walking the tightrope of trying to not put us into a recession, but kind of putting us into a recession, which slows down inflation. If we lower rates, it's going to speed that all up. So he's been walking that fine line, and some people will argue that he did an incredibly good job, and maybe he has been, but that's what he's doing. He's doing it with a large demographic coming through home buying years, so you have to keep rates high to get that going. So gold, basically did well under those market conditions of him walking that line. And then when that line is walked back in terms of rates, I think we're going to see an inflation get unleashed. Ross Brown says, watching to see if value can start to outperform growth on a relative basis, signaling a potential counter trend move down at major support level for the Russell 1000 value to Russell 1000 growth. There's your bottoms coming out. It looks like it's going to try to turn higher. Generally, when value outperforms growth is when you get a commodity bull market. So it looks like that's trying to bottom there and turn higher. This is a shorter term time frame. It's 24 and 25 there. So it's not a big long-term chart. Sam Gatling, he's talking to home builders here. I love it. He says the bulls are reclaiming control of the trend in the home builders. Meanwhile, the short sellers are carrying their largest position in years. The squeeze potential here is enormous. So we're looking at home builders, and they're actually ready to go higher. That also coincides with the strength in copper, the strength in platinum, and eventually it's going to have strength in oil. So I think the whole market's turning. I don't know if the market is anticipating a rate cut coming up here. Maybe it is, but this is all positive signs for the commodity bull market. Home builders go up generally at the same time as oil, and a lot of these other ones go up too. They kind of move together as money flows through the system, and a lot of the money is created from new homes being built. So this looks good for the economy, and it looks really strong, and hopefully we get a big move higher in home builders. Ian McMillan says, absolutely no one gives a crap about your process if the outcome, i.e. the performance versus a benchmark, is crap. So what is he responding to? He says, process matters more than the outcome. If you follow a good process, the outcome will eventually take care of itself. Well, I think that's kind of what we're all trying to do. We're trying to modify or edit and refine the process to get better, predictable, and more returns for the outcome. So our benchmark is your outcome, but the process is what matters because that's what's producing outcomes. So we're tweaking the process and getting an outcome. We tweak the process, we get a different outcome. And that's where statistics and statistical analysis comes into play. And I'm not saying I'm using statistics necessarily on my portfolio, but I am using thought, logic, and statistical-based stuff to develop it. But the process does matter more than the outcome, because this is one thing I've learned in engineering is if you don't have a controlled process, you're not going to know what the drivers are for the outcomes. So if you tweak your process and it's highly controlled, and you tweak one thing and you have a lot of control over everything, you know what tweak you made and then what that correlates to an outcome. So I've made tweaks, a bunch of tweaks in my process, in how I select companies and how I weight companies, portfolio allocation, all of that. I've made tweaks all over the place. If you've been part of the website, you have known that I have changed my mind and my approach and strategies around the companies I'm selecting and how I weight those companies. So that's the process, and the process does matter because it's going to impact the outcome or your returns. Seth Klarman says, while others attempt to win every lap around the track, it is crucial to remember that to succeed at investing, you have to be around at the finish. You can't crash out. You can't go bankrupt, is what he's saying. This is U.S. DOE stocks for the week ending 6/27. Crude is up about 4 million barrels. Gasoline's up 4. Distillate's down about 2. Cushing's down 1.5. Crude ex SPR plus 4.1. SPR is 0.2 build for the SPR. So that's what we're seeing there in inventories. So a little bit of a move higher in crude stocks. Charlie Munger says, no matter how wonderful a business is, it's not worth an infinite price. We have to have a price that makes sense and gives us a margin of safety. I see that a lot with people. They don't care about price. So what they do, for for the most part, is they look at a stock, it starts going up, and then they FOMO into it. They have no idea what their margin of safety is. They have no idea what that stock is worth. And then they'll say, chart looks good, it's going to continue to go higher. Well, you're disregarding your margin of safety. You're disregarding the value that the company or business has in relationship to what you're paying. That's something you don't want to do, in my opinion. You want to always have a margin of safety. Always. Freight futures AM update, dry bulk, Capesize is up 2%, Panamax up 1%, and tankers, VLCC is down 2%, Suezmax is flat. Here's a quote or a post. Gold moves first, copper follows, oil moves last. That's been the cycle for 40 years, and right now copper is breaking out while oil hasn't budged. You know what comes next. So copper is going to break, and then oil is going to come slightly thereafter. That's what we've seen in history. Gold, copper, oil, when these things move. Copper's ready to break out. We're sitting basically at all-time highs. It's ready to run. Oil's going to move right after it. What I do, I know some people are going to say, well, I'm going to try to play copper and that, or I'm going to play gold and then move to copper and then move to oil. Well, if you're good enough at timing that, good for you. Sometimes these move together, like copper and oil can move together. And that might also be better to kind of position in both things at the same time. That's where I'm at. Instead of trying to capture and try to move around and pay a bunch of taxes, I try to capture the largest moves in the markets and position for those moves. I don't try to time the short-term market movements. Grady says silver closed for the month well above $35 level. It's now squeezed in between 35 and 37.50. Been saying for a long time that silver's climbing the right side of a huge rounded bottom arc called the break above 35 level, same day it happened. The chart is now finally ready. It's ready to go. Silver, and yeah, it looks fantastic. We're climbing the rounded arc on the right side. Real Estate Bet says, how important is rent inflation? It's really important, to the point that if you ever see someone point to CPI inflation, sans shelter, as an indicator that inflation is under control, block them immediately. He says, how many times has CPI inflation been elevated more than one quarter without a coincident or immediately following elevated rent inflation? Exactly twice. In 2005-06, for all 3 quarters, it didn't even breach 4% in early mid-2021. And how many times has rent inflation been elevated over 4% without a corresponding, coincident, or immediately following incidence of elevated CPI inflation? That hasn't happened once. From 2000 to 2002, the CPI inflation almost rose above its long-term average before recession. And there it is. Here's another one. We've had 8 recessions since the mid-1960s. Care to guess how many coincided with or were immediately preceded by episodes of elevated rent inflation? All of them. Absolutely all of them. So we've had rent inflation preceded on all of them. So that's it for that one. It says if the API is correct, distillates would fall to 22.5% below the 5-year average and 15% below year-ago levels. So we're way low on distillate inventory levels. Oil price they milked the cow too hard, and Mexican oil production drops to the lowest in 46 years. Mature oil fields and Pemex debt woos weigh on drilling. As Cantarell came into production, boosted production, and now we are in decline. Terminal decline for Mexico, Pemex. Mexico oil production is on track to plummet to levels last seen in the late 1970s, before the start of the giant Cantarell field, which is an offshore field. Our crude storage estimate for this week, EIA oil storage report, he's got a draw of 3.18, and this is what it looks like, but it looks like we had a little bit of a build this week. And that's all I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, Subscribe to the website if you like. And that's all I've got for today. So we'll catch you next time. This is Finding Value.